What a year it has been. 2024 has obviously been a year of many, many headlines, tons of market volatility, explosive moves for a whole host of financial markets. And it now winds up on a quiet week with not much macro to speak of and a holiday in the middle for most global markets. So, what we're going to do here on Macro Money is look ahead to what is coming for 2025. I'm Ilya Spivak, head of global macro here at tastylive. And what we're going to do here is first, we will review how the year has progressed so far, take a look at some almost over statistics for market performance, and then see how things begin to look as we enter the next calendar year. So, this is the performance year to date. This is December the 23rd that we are looking at this 2024. So, not quite the full year, but almost certainly, and comparing it to 2023. So we can see stocks on the whole had another year and a year of similar performance in 2023 versus 2024, looking at the S&P 500. NASDAQ, for all of everybody's screaming and stomping about its outperformance, it's actually done less well this year than last, though, of course, still a very impressive rise of nearly 28%. Risk sentiment at the other end of the spectrum getting a big boost, looking at Bitcoin up 120% as compared with the prior year's 157 almost. So a bit of a slowdown there, but certainly a dramatic increase again. And that speaking to the risk appetite on display in stock markets, but of course amplified by a less liquid speculative assets volatility profile. The interesting thing here happening in the meat of the table, though, so we can see yields basically unchanged at the front end, but a touch higher on a year when the Fed is actually cutting interest rates. The 2-year up 2.3% on last year. That's most likely because, of course, speculation for rate cuts was already well underway toward the end of last year. And this year we got just about the rate cuts we were expecting. So yields are even a touch higher. The 10-year showing a much more significant rise. So rates at the longer end of the curve, steeply higher by comparison, 18.8%, almost 19%. Curiously, in that environment, the dollar is stronger. Euro down 5.7%. The yen, the most interest rate sensitive of the bunch, down 10.4%, even as the Bank of Japan started raising rates, the only major central bank to do so. And even stranger still, against an environment where yields are higher and the dollar is stronger, gold up 26.8, almost 27%. This is an asset that hates a stronger dollar, hates higher yields because it is a natural foil for fiat currency, and it yields nothing. So when interest rates go up, gold is typically on the receiving end of selling pressure. Not this year, though. There's an interesting recharging here happening, and the mix of assets here seemingly telling us an interesting story. Crude oil, before we go on here, down for the second consecutive year, albeit less so, and that's despite ongoing geopolitical stress. This telling us that perhaps that geopolitical stress, not much of a disruptor for crude oil markets beyond general media headlines. And so the implications probably limited now that geopolitical risk seems biased to be more contained going into 2025 versus less at the beginning of the previous year. The situation in the Middle East, the situation in the Russia-Ukraine theater, seemingly not inspiring any kind of concern for crude oil, and it's marching to the beat of its own drum, and that beat is leading it a touch lower. But the story in stocks, coupled with the story in rates, coupled with the story in currencies and gold, tells an interesting tale. It tells a story of a robust U.S. economy, which, despite Fed rate cuts, has driven up yields because economic activity has demanded that rates be higher, especially down at the longer end of the curve. The dollar has continued to benefit from those higher yields as its yield profile against other currencies has looked more attractive. And gold has seemingly found a reason to go up, disconnected from geopolitics, because, of course, if it was a haven and if it was behaving as one, it would show up in crude oil gains. That, of course, the chief geopolitical risk on the board this year. And clearly, if oil doesn't care, why should gold? And indeed, gold is up with stock markets. Not much of a haven then. But gold seems to have found its support in the situation happening in China. They've bought a ton for their reserve account. They have resumed buying in November after a pause from April. And that's been an important reason why gold has managed to hold up, even as the dollar has strengthened, even as yields have gone up. But that increase in yields and that stronger dollar with stronger stocks seems to speak to the very impressive performance of the U.S. economy. As we look here, we can see as of December, the U.S. economy raging higher. The performance here being estimated by PMI numbers. They're more timely than GDP. We can see here that toward the end of the year, the composite index, which takes in both manufacturing and services, it's moving aggressively to the top right side of the chart. As a matter of fact, that is the fastest growth that we have seen in the U.S. since March of 2022. So a very significant acceleration here. As ever, these PMI numbers work around a center line of 50, where that's neutral. Above 50 is growth. Below 50 is contraction. Manufacturing, we can see, is still in contraction, albeit at a modest speed. The further you go under 50, the faster the contraction. The further you go above 50, the faster the growth. So we can see a very buoyant service sector is pulling the U.S. economy higher, and slight contraction in manufacturing is not holding it back. That ostensibly helps to explain how you get very strong stock markets, you get higher yields and a stronger dollar, even as the Fed cuts rates. But when we look at the situation globally, we find something much more circumspect. Take a look from the beginning of this year for the global PMI numbers that include the U.S., of course, but also the other economies. And what we find is we haven't done a whole lot. The composite index here, only very little change. There was a pop in the first half of the year. That pop has since fizzled. And so the pace of economic growth is just about where we started the year. It has seemingly stopped improving. And that's because the global service sector has taken quite a few steps back since the middle of the year. And manufacturing, although it was much worse earlier than it is now, it seemingly has returned back to the neutral reading of 50. It nevertheless remains downbeat the world over. So what's going on here? Well, we see here, of course, that the U.S. is mainly powered by its service sector, and we know that most of U.S. imports, that is from the world at large, are on the good side. Services are mainly furnished by domestic firms. So a lot of this boom is staying inside the US and not spilling over, even to very close proximity, very integrated economies like Canada. And so this is why the global picture looks much more anemic than the US one. Now, global GDP growth is mainly dependent on three core economies. The US is, of course, the biggest one. Then there is the Eurozone and China. We can see here that the remaining 42% to those three economies, 58%, are mainly vendors that depend on demand from the former three. So think Canada and the US, or Mexico and the US. Think Southeast Asia or the commodity exporting countries in South America, Australia as well, New Zealand as well, and China. Think Central Europe, Nordic Europe as vendors for the Eurozone. And you can see that these three economies are really the linchpins of where growth comes from. And we've already seen that the US is very strong. The situation in the Eurozone is much more sobering, as we can see. The regional economy shrinking for the past 2 months, the composite index sub 50, even as services rebound in December. The situation in manufacturing, as it is globally, anemic, but the rebound that we saw in the first half of the year, arguably a big reason why this global number started to pop by mid-year, that has fallen away. And now the economy is again flirting with recession-like conditions. The situation in China is one of standstill. These numbers run through November. We haven't seen December's figures yet, but as we can see, these are official figures here. This is China's reopening from zero COVID restrictions. We get a brief pop in service sector and composite demand, the pop in manufacturing much more modest. And since then, after just basically a quarter of an initial upswing, the economy drops and settles into standstill. These numbers are barely removed from the center line at 50. So in one major node outside of the US, we've gone basically nowhere in 6 quarters. Indeed, the economy is in deflation mode, where real GDP is outpacing nominal, suggesting that there is virtually no demand to speak of. And in the other, we've returned to what can become recession-like dynamics. Once again, after this shallow recession-like dip late last year. So the world is operating on what is essentially one leg of the stool. It is the US that is powering global growth, and there is no plan B as we go into 2025. Where this becomes a challenge is in the US, inflation has stopped cooling and is starting to tick up a little bit. The most recent numbers for the Fed's favorite inflation gauge, the PCE index, showing that we're holding at 2.8% on core, and the headline number even moving higher, albeit a little bit less than expected, to 2.4%. Now, this is, as ever, we can see having to do with the service sector being as strong as it is, core services where that inflation lives, core goods still slightly negative in their contribution to price, which of course tells you why the US boom isn't spilling over, as we've just mentioned, and housing still largely locked up by what the Fed has done with hiking rates as sharply as it did in 2022. So that bit is waiting for the central bank to cut rates more and perhaps unlock this market. But as we start to get a tick up in core inflation, and indeed at 2.8%, what this means is essentially we have not seen disinflation in the US of any kind since June. June was the last time that we ticked down on core year-on-year PCE. Since then, for the subsequent 5 months, inflation has not fallen. And so what we understandably have seen as a response is the Fed has become more hawkish. The markets have called for it, and the Fed has responded. We can see here that where the policy curve looked like it was going in September has been adjusted substantially to a more hawkish setting, even as the Fed began to cut a little bit in the waning quarter of the year here. Of course, 50 basis points cut in September, a 25 basis point cut in November and December, respectively. Nevertheless, the path forward now much shallower. Rates expected to be a full 100 plus basis points higher, closer to 4 than 3 by the end of the year, because inflation has proven stickier. Now, it's possible that the markets have overcooked this a little bit, because we can see that since mid-November, U.S. economic data has actually been cooling relative to forecasts. So maybe this adjustment has gone a little far. Maybe the markets are a little bit too hawkish, bonds a little bit too weak, rates and the dollar a little bit too high. But none of that changes the inflationary path. So although the markets might be wrong by a little, they're probably not wrong by a lot, and they're probably not wrong about the trend of adjustment here. So we're looking at structurally higher rates next year in the U.S. than we thought even 3 months ago, 4 months ago, and by a significant margin. This, of course, represents a problem not just for the U.S., but for the world over. So we can see here in the latest numbers from the Bank of International Settlements, and 2022 is the last time they had an update. There'll be another one next year. They do this every 3 years. But these numbers don't change terribly, especially when the disparity is this large. Notice almost all global monetary transactions are settled in the US dollar. Those of you that have heard various chatter about the BRICS maybe coming up with an alternative should look at this sobering total here. This is all of the turnover moving through the BRICS, of which, as we can see very clearly here, most is China. And everything else, India or Russia or indeed some of the others are clearly a pittance comparatively. Here's South Africa right here. So, and of course, there's Brazil. So most of what's here is settled in dollars, and that's because the dollar is so liquid that it is sometimes cheaper, even when there is a bilateral deal to transact from one non-US dollar economy to another. It is cheaper sometimes to trade that currency for dollars and dollars into the third currency versus to do a bilateral deal, because the liquidity of the dollar is so abundant that that's the cheaper way of trading. So not surprisingly, almost all global commerce is settled ultimately in dollars. And what this means is that if the Fed gets a little bit more hawkish and rates don't come down by nearly as much and dollar credit is more expensive, then global credit costs are higher in general. And we can see that as we look at the way that an average of interest rates from the key economies in Europe and the Asia-Pacific region, Germany, UK, Australia, Japan, the top 4 outside of the US, how their interest rates have moved in lockstep with the US 10-year, even as central banks in the UK and in Germany have cut. The Bank of Japan has hiked. The Bank of the central bank in Australia, the RBA, they've done nothing. But even as that has happened, the rise in U.S. yields has brought a rise in the average of the other 4 of the alternatives. And that just tells you how ubiquitous the dollar is in global trade. That, of course, sets up a very interesting situation for 2025, where the robust performance in the US means higher rates in the US, but also higher rates on weak economies that are not seeing the boom that the US is seeing. Moreover, since the world is dependent on a single point of failure, the US economy's economic strength, it is certainly a point of interest that interest rates are set to be higher there, even just locally, because, of course, that would perhaps start to hold back US growth, and to that extent, hold back global growth because there is no backup. So the risk to global economic performance is a significant thing to keep an eye on, and a significant risk for markets as the calendar turns to 2025. Moreover, the stock of global growth is huge by any stretch of the imagination at a time when interest rates are going to end up higher than expected, it would seem. We can see here the full breakdown from the IMF. We find that in debt to GDP terms, because, of course, debt is not scary in absolute, it is only scary if you can't afford it. And debt to GDP tells you how affordable is the debt, are you producing enough economic growth to service it? And of course, in the COVID years, we can see there's a massive surge for global debt, as well as for the major economies, the emerging markets, the US and China. The change in global debt was significantly lower in the subsequent years because inflation was roaring and inflating that debt away relative to growth. Well, that seems to have stopped for the world in 2023, where public debt is starting to grow a bit. That's mainly powered by what's going on in the US, of course, and China, and to some extent, emerging markets. But we are now in a place where inflation has come down a lot, almost everywhere, from double digits or close to them, to levels that are much closer, if not quite at, central banks' targets in the sort of 1 to 3% range, depending where you look. And with that, the shaving away of debt relative to GDP, so the affordability improvement that we saw here and here and here and here, is ostensibly over. If you were to find yourself in a global scenario where the US buckles under higher rates, where already weak economies outside of the US have to deal with those higher rates without the benefit of stronger growth, you start to see how a treacherous debt risk starts to emerge. This is made that much worse because this particular US tightening cycle has been unique since the modern era. This is a chart from The Economist going back to 1972. Very important look back period because that's right around when the modern financial system as we know it is born, with the uncoupling of gold and the US dollar and the dawn of the fiat era. So what we find here is that in every other tightening cycle, they're listed here, the outlays by non-financial firms, that is regular businesses, on credit increase when the Fed raises rates. That's, of course, exactly the idea. The Fed is looking to slow inflation, slow the economy, and so it's raising rates to increase how much firms are spending to borrow, to discourage them from borrowing, and cool the business cycle. The 2021 to 2023 rate cut cycle has not done that. And the reason it's not, the reason that actually credit outlays mysteriously are falling even as rates go up, is because during the COVID years, everybody gorged on cheap credit. Well, that cheap credit comes due mainly next year and 2026, and at interest rates that are 200, 300, 400 times those that were incurred. If this happens at a time when GDP growth slows because rates are already high and going to be higher than previously anticipated, then of course debt affordability is that much scarier. Couple that with the most bullish disposition for risk sentiment that could be imagined. A survey here from the conference board showing in the US the percent of respondents expecting stock prices to be higher next year, off the charts. The allocation to equities has only been higher all the way back here at the start of the global financial crisis, and then back in the dot-com era. The allocation to cash has never been lower, looking all the way back to the second half of the 1990s. And so what we find here is tremendously robust risk appetite, which of course is clearly on display when we look at this performance. Now, given the risks, one has to wonder. Optimism is always highest at the peak. This is by definition the peak. But is this the peak? Or could optimism continue to build? It certainly could. But the way the table is set, one does have to wonder if indeed we've reached that peak or close to it, and if equities are in for a rude awakening next year as markets digest all of what's ahead. And that is macro money for today. As ever, we are here right after overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. It is a holiday-shortened week, but we will be back on Thursday after market closures around most of the world, and we'll have two shows for you next week as well around the New Year's holiday before we come back to regular scheduling. You can follow me here and, of course, opining on the platforms formerly known as Twitter, as well as now on Blue Sky at Ilya Spivak. Thanks for watching. Have a great holiday, whatever you happen to be celebrating. Macro Money will be back on Thursday to finish out the week.